Let me therefore turn to look at the world economy as a whole before I look briefly at the two most important advanced economies and see how their economies are reacting. This chart here shows quarterly growth in the OECD area. That's a group of 34 mostly advanced economies, and also the world as a whole, proxied here by figures from roughly 95 countries who do produce quarterly national accounts estimates, GDP growth estimates, who in turn account for about 90% of world GDP. Both the charts show, of course, very significant declines in economic activity in the first quarter of this year. It's interesting that the downturn in OECD economies, at least up to the March quarter, hasn't been as severe as the downturn during the global financial crisis of 2008-9, which of course was centered in advanced economies, particularly those on either side of the North Atlantic, whereas for the world as a whole, the downturn up to the March quarter, the contraction up to the March quarter, was larger than anything that occurred during the global financial crisis, because most of the developing world was relatively unscathed by the financial crisis of 2008-9. However, as we'll see when second quarter numbers are published, as they now have been for a handful of economies, that comparison is probably going to look worse for the current episode, both for developed economies and for developing economies. Both are going to see bigger downturns than they've seen probably at any time since the 1930s in most cases. And that's certainly the view of the leading international forecasting agencies, all of whom are forecasting that economic activity for the world as a whole and for most of the world's major economies will decline by more in 2020 than in any year since the early 1930s. The forecasts aren't all the same. The World Bank and the OECD are more pessimistic about the economic outlook for this year than the IMF is. The IMF is more pessimistic about the United States than the World Bank or the OECD, though less pessimistic about the Euro area. The IMF is much more pessimistic about India than either of the World Bank or the OECD. And the OECD is much more pessimistic about China, forecasting a 2.6% contraction in 2020, which I think probably looks too negative in the light of China's second quarter growth figures, as opposed to 1% that the World Bank and the IMF are forecasting. But there's no way, two ways around it. Everyone expects 2020 to be a horrible year for economic activity. And although all of these forecasting agencies are tipping quite strong rebounds in 2021, a lot of that's mechanical. A lot of it's based on the assumption that there won't be a second wave of infections. And even with those significant rebounds that are forecast, the level of economic activity in most economies by the end of next year will still be some way below where it had been in the second half of 2019. Just by way of illustration of one of these forecasts, the World Bank, which forecast a 5.2% decline in world GDP, included in its most recent Outlook publication data for global GDP going back to 1871. And they think that the downturn the world economy is now experiencing will be the fourth worst in any over the last 150 years, exceeded only by the contraction that followed on the demobilization of military forces following the end of World War II, the Great Depression itself of the early 1930s, and the depression that struck most economies in the first year of World War I, that was in 1914. So by comparison with those three events, it's maybe not quite as bad, but certainly worse than anything that has been experienced since the end of the Second World War, and worse than anything in the living memory, I would think, of more than 3/4 of the world's population alive today. Just a couple of other interesting dimensions of this. Trade, which is very important for Asian countries, most of whom are significantly dependent on trade, something we'll look at in a few moments. collapsed by 12.2% in April and then fell a further 1.1% in May, according to the measure of the volume of world trade that's compiled by the Netherlands Economic Planning Bureau. In total, the volume of world trade is now 18% below its peak in August last year. And that's almost as big a decline as occurred during the global financial crisis of 2008-09. Trade has been slowing for some time, partly because of the deteriorating trade policy environment. As you can see from the right-hand chart, since the financial crisis of 12 years ago, countries around the world have taken significantly more trade policy measures that are harmful to trade, increasing tariffs, imposing quotas, or erecting other barriers to the movements of goods across international borders, whilst in marked contrast to the 1980s and 1990s in particular, there have been far fewer measures directed towards liberalising trade to make it easier for people to export and import goods across international borders. Most economists would regard that as measures that detract from welfare and would be critical of those. It's partly, of course, due to Donald Trump's trade war and America First trade policies, but that's not the only factor involved, and many other countries beside the United States have also been guilty of implementing measures that harm trade, and by harming trade, harm their own people as well. Most people, and especially most politicians, don't seem to realise that tariffs aren't something that you make foreigners pay to get their goods into your country. They're actually something that you make your own consumers pay to keep foreign-made goods and services out of your country. And that's why so many economists regard trade policies as particularly damaging, not only to the countries at whom they're directed, but also to the people who live in the countries which impose those measures. There are lots of other data that economists have been using to track how economies are being affected by the imposition of restrictions and the subsequent easing of them, and by the ebb and flow of infections and deaths. They need to do that because official statistics compiled by central banks, government departments and statistical agencies often come out with a considerable lag, making it very difficult to know what's happening in real time or as close as we can get to that. The tech giants, Apple and Google, have been publishing since mid-March data drawn from their own sources that illustrate the extent to which people in different countries around the world are driving, catching public transport, going to workplaces, shopping, or staying at home. And you can see from some of this data that, particularly in Asia, life has been returning to normal gradually, but more consistently than it has been in North America or many European countries. And that, of course, reflects in large part what I said earlier about the greater success that most Asian countries, particularly in East Asia, have had in containing the spread of the virus. Another interesting data to look at that's almost in real time comes from the aviation world, which of course has been one of the areas of economic activity that's been much more seriously impacted by restrictions on what people can do than other parts. Commercial aviation, as measured by the number of flights, at one point through early April was down almost 80% from pre-pandemic levels. It had begun to recover over the course of May, June and early July to be about 38% below its pre-pandemic level. But as you can see, it's in the last few weeks apparently leveled out. Another illustration of the same thing, but confined to the United States, is the data which the Transport Safety Administration in the United States, they're the people who humiliate you by confiscating your shaving cream or your perfume when you go through security checks, and they seem to like picking on people with hip replacements or people wearing suits. Probably the only useful thing that's come out of airport security has been this data, which shows that the number of people being subject to those ritual humiliations plummeted in the United States States by almost 100% between the end of February and the middle of April. It had begun to recover gradually up to the early part of July, but since then, it too, like global aviation trends, has appeared to have leveled out. Turning to more conventional economic data, many economists look to the so-called purchasing managers indexes, which are based on surveys of corporate officers who are responsible for purchasing materials at factories, offices, and other service providers in many countries around the world for an inside read into how economic activity may be performing or changing. And these surveys typically come out on the first, second, or third business day of each month for manufacturing, and a couple of days later than that for services activity. So they're amongst the earliest leading indicators that we have to get a read on what might be happening. And all of those indices showed very sharp declines, particularly in services activities, which of course were more likely to have been affected by restrictions on the movement and gathering of people than the manufacturing of goods would have been. All of those showed very sharp declines in March and April, but in most countries there's been a significant rebound. Brazil is really the only exception to that, that's occurred in May and June, and of course we'll get July figures through next week that'll probably show in some countries a bit of slippage in the level of activity in July, but in some others there might be some ongoing progress in recovering to more normal levels of activity. In response to these very severe downturns, governments appear to be doing, in most cases, at least among the major economies, rather more by way of providing fiscal stimulus, that is, increasing government spending, making loans, or cutting taxes, than they did during the financial crisis of 12 years ago. And they're doing that even though they went into this downturn with their public finances, in most cases, in much worse shape than they were before the financial crisis hit in 2008, in large part because of the measures that they took in response to that crisis. Almost every major economy is going to run a bigger budget deficit in 2020, and in some cases in 2021, than they did at the height of the financial crisis in 2008-9. Japan's one exception, the UK is another. In the UK's case, that's because their deficits during the financial crisis were exaggerated by the takeovers the British government undertook at that time of banks that would probably otherwise have gone bankrupt. But certainly the US, the Euro area, Canada, Australia, New Zealand, and importantly for today's presentation, China, all seem to be doing more on the fiscal policy front than they did 12 years ago. In addition, of course, central banks have been attempting to support economic activity as well. There hasn't been a lot of scope for most of the major central banks in the world to cut interest rates as aggressively as they did 12 years ago, with the exception perhaps of the United States and Canada that had raised interest rates during the 2 or 3 years prior to 2019, and of course have been very prompt in cutting them as soon as the dimensions of the most recent crisis became readily apparent. One thing that I think is interesting here is that those central banks which had experimented with negative interest rates, including the Bank of Japan and the European Central Bank, as well as the central banks of Switzerland and Denmark, haven't seen fit to take their policy rates further into negative territory, despite the severity of the downturn that they're all now experiencing. I think that probably tells us something about what they've realized about the efficacy of negative interest rates. They don't actually really do much good, not least because banks which are subject to negative interest rates on the deposits they hold with their central banks haven't passed on negative interest rates to their customers. What that's in turn, of course, meant is that the profitability of banks has been squeezed. And while not many people are going to feel sorry for banks for that reason, as Australia's finance minister used to say more than 20 years ago, or almost 20 years ago, if there's one thing worse than profitable banks, it's unprofitable banks. Unprofitable banks wouldn't be able to play the role they're expected to in this downturn of providing lending and liquidity support to businesses and households who are trying to maintain their existence in circumstances where they've got little or no income. Just because central banks haven't got much scope to cut interest rates in the conventional way, however, doesn't mean that there's nothing else they can do. Every major central bank in the developed world has engaged in quantitative easing, that is, purchasing government securities, and in some cases, private sector securities as well, and or directly lending to financial institutions, and in some cases to non-financial institutions, to businesses, on a scale much bigger than they did during the financial crisis of 2008-9. And you can see that in the right-hand chart by looking at just how much and how quickly the balance sheets of the 5 biggest central banks in the developed world have expanded over a relatively short period of about 3 months. That includes the Bank of Canada, that didn't do any quantitative easing at all during the financial crisis, in part because, unlike the other countries shown on this chart, their banks were relatively unscathed by the turmoil that was at the heart of the global financial crisis. One consequence of all this quantitative easing, of course, is that central banks, some of whom already owed quite a significant proportion of their corresponding government debts as a result of what they've been doing since the financial crisis, are going to end up with even more of it once all of this is over and done. The Bank of Japan, for example, will probably end up owning more than 50% of the stock of Japanese government bonds outstanding. The Bank of England and the Bundesbank, likewise, already own more than a third of their respective government's debt, and they'll probably end up with more of it before this is over. In some cases, where countries have very large debt relative to the size of their economies, Japan being the most obvious case, but this could also apply, for example, in the UK or in Italy, it may be that at some point in the future, governments decide to cancel the debt which is owed to their central banks. That would, of course, put those central banks in a position of negative equity, but that probably wouldn't be as damaging for them as it would be for a commercial bank, since central banks don't need to provide capital in order to offset the impact of bad loans, and they don't need to have capital in order to persuade depositors that they're safe places to leave their money. Some of the academic literature suggests that central banks with negative capital might not be credible in terms of their commitment to keeping inflation low, but I'd suggest in those circumstances that's the least of central banks' concerns. Another possibility may be that governments and central banks will agree, or governments will dictate to central banks, that they should swap the debt which they end up holding for long-term or possibly even perpetual government bonds, what in the British world was sometimes called consols, carrying very low or zero coupon interest rates as a way of assisting governments manage what for many of them will be a very heavy debt load, and reduce the risks posed to governments by the possibility that at some point in the future interest rates may no longer be as low as they are today. Certainly those central bank actions helped prevent the uncertainty that roiled financial markets towards the end of March from becoming yet another global financial crisis. At one point in mid-March, stock markets had fallen by more than 30% in most countries. Volatility had spiked, and even safe assets like US Treasury bonds and their equivalents in other countries were not markets for those had become rather dislocated. The central bank action certainly corrected all of those. Since then, most stock markets have recovered a good deal, if not all, of their earlier losses. Volatility has settled down. Bond yields have essentially been moving sideways. And the only real significant development in financial markets over the past month or so has been a significant depreciation of the US dollar, particularly against the euro, but also in the past few weeks against the yen and other countries' currencies. That probably reflects growing disenchantment with the incompetent way in which the Trump administration and A majority of state governments in the United States are handling the coronavirus. You can see that just with the inability that the US political system has shown this week in addressing the fact that a number of the important support measures put in place early in this crisis are due to expire without any replacement having been agreed upon. To say nothing, of course, of the disregard which the president and many governors of US states have shown for scientific and health advice, in contrast to the approach that's been taken by most Asian and most European countries since the pandemic broke. The fall in the US dollar is in turn probably the principal reason why the gold price has been setting new records in recent days. And that's obviously something to keep an eye on, because a big fall in the US dollar would by definition mean an appreciation of other countries' currencies. And for countries that are particularly dependent on exports, and there are plenty of those in Asia, that could be something that would be quite disconcerting to their recovery prospects. All of this quantitative easing by central banks in major economies has promoted a much faster acceleration in broader measures of money supply growth than it did during the financial crisis of 12 years ago. Of course, back then, the banking system was incapable of performing its usual functions, so the creation of money by central banks wasn't transmitted to the rest of the economy in the way that it otherwise might have been. Now, by contrast, we can see that in the United States, broader money supply growth has been faster than at any time since at least 1960. In Japan, which has had enormous difficulty generating money supply growth and boosting bank lending for most of the past 30 years, has seen its fastest money supply growth since January 1991. In the UK and the Euro area, the acceleration hasn't been quite as dramatic to break long-term records, but even there you can see that money supply growth both in the UK and the Euro area has picked up quite significantly. Some of that probably reflects the demand for precautionary cash balances on the part of businesses who think they might need to draw on cash reserves in order to meet their expenses during a period in which they've got little income. And certainly there's no evidence so far, and I don't expect there will be anytime soon, that this acceleration in money supply growth is giving rise to an acceleration in inflation in the way that Milton Friedman in particular made famous during the 1970s and 1980s. Of course, Friedman used to say that the lags between money supply growth and inflation were long and variable, so the fact that inflation has remained very low and fallen further since the crisis broke, despite the acceleration in money supply growth, doesn't necessarily mean it won't happen at some point in the future. But at least for the next few years, I would think falling inflation below target inflation is going to be a bigger problem for most central banks than inflation moving back above their target range. Let me just finish this section by looking quickly at what's happening in the two most important advanced economies in the world. Last night, our and Asian time, the US reported that real GDP contracted by 9.5%, or as they say, at an annualized rate of 32.9% in the second quarter of 2020. That's by a wide margin the biggest decline in economic activity that's occurred in a single quarter since the United States first started reporting quarterly GDP estimates way back in 1948. The previous record was a decline of 10% at an annual rate in the first quarter of 1958. That was actually the quarter I was born in, but that wasn't in the United States, and I don't think that actually had anything to do with it. It's a very serious contraction and was evident across all areas of economic activity. It's worth noting, and I'll show this in a minute, that Germany's economy contracted by almost exactly the same amount in the second quarter in its data that was also released last night, our time. But the United States has had 4 times as many deaths per head of population and 5 times as many cases per head of population as Germany has experienced over the same period, and yet they've paid the same economic price for those results, which again speaks to how ineptly all of this has been handled in the United States. The New York Fed publishes a weekly index of economic activity across the whole United States, which is calibrated in such a way as to mirror what quarterly GDP is likely to say. That measure accurately predicted that real GDP would have declined by about 33% at an annualized rate during the second quarter. And the readings so far during July suggest that GDP is about 3.2% higher at an annualized rate so far during the third quarter, but of course we've still got 2 months to go, and they may not be as strong as July was by comparison. Looking elsewhere, consumer sentiment is still fairly weak. Despite that, retail sales have rebounded strongly so far in May and June to actually be back where they were before the pandemic broke. On the other hand, industrial production has risen much less and is still, as of June, about 11% below where it was going into the pandemic. The crisis has taken a particularly severe toll of the labour market in the United States. A third of the entire US workforce, as of late March, has filed for unemployment benefits over the period since then. And although the rate of new claims has slowed substantially since the end of April, it's still higher than at any time during the previous 52 years for which this data has been published every Thursday morning. Well, now, you can see that there's also been a record number of layoffs during this period. So not surprisingly, there has been substantial record-breaking monthly movements in employment during that period. Although employment rose quite strongly in June and in May, it wasn't nearly enough to offset the decline in employment that occurred in March and April. And so the total level of employment is still almost 10% below its pre-pandemic peak. That's a much bigger decline in employment than has occurred in any of the previous US recessions. It was enough to push the unemployment rate up as measured to 14.7% in April, although if all of the people who dropped out of the workforce, something illustrated by the decline in the labour force participation rate that you can see in the top right-hand chart, had been counted as unemployed, then that rate would have been over 19% in April, and despite having fallen since then, would still have been 14.5% in June, well above the published unemployment rate of 11.1%. Another way of grasping the decline in employment is to look at the proportion of the population aged 15 and over who are actually working. And in June, that was 55% or 54.5%, higher than it had been in April and May, but apart from those months, lower than at any time since the end of World War II. And for most of the 20 years after World War II, of course, most women didn't work, in contrast to the situation today. So that just illustrates how devastating the impact on the labour market this recession has actually been. It's also taken a heavy toll of US government finances, as you can see from these two charts. US public finances had already been deteriorating steadily since President Trump moved into the White House. In Barack Obama's last year in office, the budget deficit, which had been over $1 trillion when he came to office in 2009, had fallen to $582 billion. But over the following 3 years, Donald Trump's administration and its colleagues in Congress had managed to blow it out to $1 trillion, while gross debt, something that Republicans used to rail against when Democratic administrations ran it up, had increased by more than $4 trillion to over 1.25 times annual GDP. In March, before the pandemic really hit the United States, the Congressional Budget Office, that's the independent agency that makes forecasts of public finances in the US, forecast that the deficit would remain above $1 trillion every year over the coming decade, reaching $1.75 trillion by 2030. Well, the US actually ran a budget deficit of $845 billion in the month of June alone. In the June quarter, it was $2 trillion. In the 12 months ended June, it was $3 trillion, or almost a sixth of GDP, almost double what it had been at its greatest extent during the financial crisis, and in fact the biggest deficit in any 12-month period since the last year of World War II. And reflecting that, what the federal government in the United States owes has increased to almost 29 trillion US dollars, or almost 1.5 times the US's annual income. And that's going to get much worse over the next year or so. Problem for whoever's the next president of the United States to deal with. Finally, a quick look at Europe. As I mentioned, Germany experienced the same roughly decline in real GDP in the second quarter of the year as the United States did. And later tonight, in about an hour's time from when this is being recorded, we'll get a preliminary estimate of GDP growth for the euro area as a whole, which may be worse than Germany's was. Certainly France, Italy and Spain, the next biggest economies in the euro area, experienced bigger declines in the first quarter than Germany did. So it wouldn't be surprised if the euro area as a whole had a bigger decline in the second quarter as well. The UK is going to be in for a horrible result when it comes out on the 12th of August. The UK's statistical agency does publish a monthly estimate for GDP, and in April and May, that was down 24.6% on the corresponding period of 2019. If that's maintained for the June quarter as a whole, that would represent the biggest annual decline in real GDP since 1706. Not entirely sure what was happening in 1706. It was probably a very bad year for agricultural production, which would have made up the vast majority of the UK's GDP if they were actually measuring it back then. So they're likely to have a bad experience as well. And one area of difference between continental Europe and the US is that unemployment isn't rising nearly as much there as it has done in the US or Canada, nor for that matter in Australia either. We learned last night, our time, when the data for June was released, that euro area unemployment had risen to 7.8%. That's only an increase of 0.5 percentage point from the low point in February this year. And that, of course, reflects the fact that wage subsidy schemes and furlough arrangements have been much more prevalent in the euro area than they have in the US or Canada, or for that matter, in Australia. And probably also the case it is the case that in the euro area, people who are furloughed, that is, who aren't actually dismissed or retrenched from their jobs, but remain on the books of their employers, even though they're not necessarily working any hours, they're counted as employed in most European countries, whereas in the United States and Canada, they're counted as unemployed. In the UK, there would appear to have been, based on the number of people claiming unemployment benefits in the last 2 months, a significant increase in the unemployment rate from below 4% earlier this year to somewhere around 8% as of June, though we won't get official labour force data showing that for another couple of months yet. So that's a roundup of how the world as a whole and briefly the two most important advanced economies in the world have been faring. If you'd like to see the slides again, or to look at Wednesday's presentation, which mainly focused on the Australian economy, you'll be able to find that on the website over the weekend. You can also see how to subscribe to a weekly update of these and other charts and gain access to other material and talks that will only be available very soon to subscribers. Thank you for being here this afternoon. I hope you found these slides useful in the decisions that you may have to make about your business or your investments, or maybe they've just brought you up to speed with an important region of the world economy, whether it's where you live or one in which you take an ongoing interest. If there are any questions, I'd be delighted to do my best to attempt to answer them. But otherwise, can I again thank you for being here and look forward to engaging with you once again.